If you are just joining us, it is your number one authoritative business radio. That is Broad Street Radio. Wow, what a wonderful week. Yes, today we are going to be looking at, oh, pardon me, my name still remains Charles Fakro. And of course, it's your regular show, Investors Education Series. Yes, and today we'll be talking about, look at a new series. We're talking about green finance. Yes, green finance. We've heard this term used in so many places, and we'll say greenwashing, you know, green finance, green economy. So today we want to ensure that our investors, our listeners understand when we talk about green finance, what are the scope of green finance? What is green finance? What are the scope of green finance? And let's look at some historical background and evolution of green finance. And of course, what is the importance of this green finance in addressing climate change and environmental degradation? So anywhere you go, everybody they are talking of green finance, green finance, green finance, sustainable finance. So let's see what this green finance is all about. So when we say green finance, we are referring to the use of financial instruments, mechanism, and services to promote environmental sustainability and reduce climate change. It involves the integration of environmental consideration into financial decision making with the goal of supporting the transition to a low carbon economy. Now, the essence is you consider the environment while making financial investment decision, which is key. Because your 1 naira should not go to assist in the destruction of this planet. So, and that is what is a green finance, to ensure that when you make any investment, it is done in such a way that the instrument you invest in, the processes, the mechanism, okay, is used to promote environmental sustainability. We talk of low carbon economy. Yes, when we burn certain fuel, fossil fuel, particularly, we release a lot of what they call greenhouse gases. We have methane, a lot of carbon, and of course, this goes a long way in trying to make that is the ozone layer and all that. And the planet, we all discover that it is becoming hotter and hotter, every day. And that is the issue of climate change. So green finance has come to address some of those issues. So we need to lay out a strong foundation for green finance. Like I said, it refers to the use of financial instruments, mechanism, and services, to promote environmental sustainability and reduce climate change. Now, what is the scope of this green finance? How can we apply it? How can investor begin to understand green finance and apply it? But that is the most important thing. Now, the scope of green finance is broad and encompasses various aspects, including renewable energy finance. Renewable energy finance, that is financing for renewable energy projects such as solar, wind, and of course, hydroelectric power. So if a financial institution is involved in financing renewable energy, we will also say they are into green financing. Energy efficient finance. These are the scope of green finance. Financing for energy efficient projects such as building insulation and efficient lighting. Now, in mortgage or housing, they're even talking of energy efficient building. That is, we don't just waste energy, okay? And the energy we install, the lighting system we install in buildings should be used efficiently. That is also part of green finance. Sustainable infrastructure finance. Financing for sustainable infrastructure projects such as green building, sustainable transportation, and green urban planning. All these are green finance. I mean, we need to be intentional now in the built environment. That they are building a house, they need to ensure that all the sustainability principles are adhered to. Then, of course, green bonds. Bonds specifically issued to finance green projects such as renewable energy, energy efficiency, and sustainable infrastructure. Excuse me. So we are still looking at the scope of green finance so that investors will have a broader perspective of what green finance is all about. And when they engage their financial institution, they will be in a better position to know whether these financial institutions, their instruments that they have brought, are in line with green finance. Environmental risk management. Management of environmental risks associated with financial investment, such as climate change, pollution, and natural disaster. Sustainable agricultural finance. Financing for sustainable agriculture practices such as organic farming, regenerative agriculture. All these are transformative agriculture where you make use of the land, and at the end of the day, you do not just destroy that land for agricultural purposes, So that will also fall under green finance. Then, of course, green microfinance. Excuse me. Green microfinance. That's microfinance services targeted at supporting green entrepreneurship and sustainable livelihoods. Climate change, adaptation, and resilience. Financing for climate change, adaptation, and resilience projects such as seawalls, flood protection, and climate resilient infrastructure. So all these are the scope of green finance. And in the investment world, we encourage both the issuers, the investors, the regulators, the government, the community to be involved so that we all understand what this green finance is and know the purpose of it. And of course, we are gradually seeing some of the importance of this green finance. So, but not when a company is saying they are practicing green finance. And when you look at their credit facility, they are supporting projects that are not friendly to the environment. That will not be green finance. For me, that would be green washing. That is, you are just telling the public what you are not. So what are some of the benefits of green finance? The benefits of green finance include reduce environmental impact. So green finance promotes sustainable development and reduces environmental impact. Improved risk management. Increase investment opportunities. Job creation and economic growth. These are some of the benefits of green finance. Again, it is not just easy. People who have been used to, let's take a factory for example, that they've been used to discharging their waste. They don't treat it properly before they discharge. Then they've installed all their system to operate in that way. Now they are not trying to embrace green finance. Then you will see that it's going to take some time. So there are challenges and at the same time opportunities. So despite the benefits of green finance, it also faces some challenges. And let's look at some of these challenges. Limited awareness and education. Limited awareness and education about green finance among investors, financial institutions, and project developers. Today, I still see some housing agents, estate agents who don't really understand what green finance is all about and how they are supposed to incorporate it in their practice. In fact, when you run certain projects, it has to be green. because you have a responsibility to preserve planet Earth. Higher upfront costs. Yes, people have done the cost benefit analysis and say, yes, for you to go into green finance, it's a little bit costly when you start. So that is higher upfront costs associated with green projects and technologies. If you want somebody who wants to say, okay, we want to go into solar, of course, the capital to install it and begin to use it is quite not that affordable. That's what we are trying to say. So policy and regulatory framework. Lack of supportive policy and regulatory framework for green finance. Some governments, in terms of policy making, they are still trying to understand this green finance. And I know it's going to take some time before even the policy makers will understand this essence of green finance, so that by the time they are making policies, they will be doing that from an advantageous position. And that is why we here on Broad Street, in Broad Street Radio, we do all we can to ensure that our investors, our stakeholders, are all educated when it comes to different areas of finance. So that's why today we are looking at green finance. Scalability and mainstreaming. Need for green finance to scale up and become mainstream. That is, more and more people need to begin to embrace this green finance for any project they want to do. Ensure that environmental impact assessment is done, so that it becomes the normal, it becomes the norm. So we will encourage everybody to try and understand what green finance is all about. Like we said earlier, excuse me. Like we said earlier, it refers to when financial institutions come up with instruments that take the environment into consideration before making an investment decision. Okay, so but despite all these challenges, also present opportunities for innovation, growth, and development in the green finance industry. So, how the green finance, how did it start? Let's look at some of a brief history, looking at the early beginnings from the 1960s to the 1980s. We started having environmental movement. You know, of course, the Industrial Revolution, we saw a lot of pollution in the environment. Of course, the industrialists at that time were acting out of ignorance and they were making their money. But on the other hand, they were also now destroying the environment. So in the early 1960s to 80s, we had the environmental movement. The modern environmental movement began in the 1960s, raising awareness about pollution, conservation, and of course, sustainability. Then the first environmental regulations came up. Government started introducing environmental regulations, such as if you go in the US, they started having a National Environmental Policy Act. That was in 1969, and the European Communities Environmental Action Program in 1973. And I think it was also in the late 80s, yes, we also started having FEPA, that is Federal Environmental Protection Agency, also in Nigeria. So people are gradually becoming aware of the environment. Of course, if you also recall, 1987, we had the Brookland meeting, Madam Prime Minister, where they now began to define what sustainability is all about, and of course, sustainable development. So these were in the 1960s and 80s, and of course, early 90s. Now, we also saw the emergence of socially responsible investment, which considers environmental, social, and environment, and the governance, that is ESG. Okay? Factors began to take shape in the 1970s and 1980s. We started talking about ESG. And of course, if you also remember, I think it was in 1992, they had the Rio de Janeiro's conference somewhere in Argentina. Okay, so the growth and development in 1990s to 2000, we saw the Rio Health Summit. That was in 1992. The United Nations Conference on Environment and Development. That's the Rio Health Summit. Highlighted the need for sustainable development and environmental protection. Establishment of the Global Reporting Initiative. That's the GRI. GRI, a non-profit organization, was founded in 1997 to promote sustainable reporting and transparency. So they now also move to the corporate sector because they know that these are the persons who probably are polluting the environment, maybe out of ignorance. So they now said, okay, let's have the GRI, Global Reporting Initiative, where you begin to report your sustainability issues, and of course, you talk about your environment. But you can see why the ESG movements, started. That is the environment, social, and governance. So it went beyond just only the environment, but even social issues and also governance issues. So in the US, we saw the launch of the Dow Jones Sustainable Index. The Dow Jones Sustainable Index, introduced in 1999, was one of the first sustainability indexes tracking the financial performance of companies that demonstrate strong ESG practices. In Nigeria here, I think we've had the Impact Board, and of course, the NGX Group PLC is also a sustainable stock exchange. They partner with so many organizations to ensure that the companies that are listed on their platform also report sustainability and ensure that they have a strong hold in terms of the ESG. Emergence of green bonds. The first green bond was issued in 2007 by the European Investment Bank to finance climate-related projects. You can see that in Nigeria here, especially in the NGX group, we've seen the green bond, launched by the Ministry of Environment earlier this year. So you can see that the NGX, that is the operating exchange of the NGX group, is in tune when it comes to sustainability and of course ESG. So green finance is gradually taking hold in most investment environment, and it is good for investors to understand it. Now let's look at the mainstreaming and expansion. That is 2010. That is 2010 to present day. United Nations Environment Program Finance Initiative. That's a UNEP, FI. UNEP launched in 2011, aims to promote sustainable finance and support the development of green financial products. Establishment of the Green Finance Initiative. The Green Finance Initiative, launched in 2016, bring together government, financial institutions, and other stakeholders to promote green finance and support for the transition to a low carbon economy. We even said in Nigeria here, I think about, is it 2050 or 2060 thereabout, we see a gradual reduction in our carbon emission. So we want to have a low carbon economy. And of course, you also have some carbon markets, and Nigeria is also getting there. So all this needs a little bit of awareness and education on the part of the investment community, the regulators, the government, and every other stakeholder, because we all have a stake on this planet. So growth of the ESG investing. ESG investing has become increasingly popular with assets under management in ESG team fund growing from over $22.8 trillion in 2016 to about $40.5 trillion in 2020. So you can see that increase. And we've also, some studies have also been done to see that companies who begin to embrace ESG in terms of their operation, how does it affect their profitability? And we have seen that companies that have adapted that ESG tend to perform better compared to companies that have not adopted the ESG, because the investors will be so confident, and of course they will know that their company is doing a lot to protect the environment. So within this same period, we also saw the development of green taxonomy. That is, they started coming out with terminologies in terms of green finance. So green terminologies like the European Union Green Bond, Standard and the Chinese Green Bond, endorsed project catalog have been developed to provide clarity and consistency in green finance marketing. We also have increased focus on climate risk and resilience. Today, we know what the climate change has done to so many peasant lives. In fact, some of the wars, insurgency that we even see in some part of Africa can be related to climate change. Because people will tell you, coming from the Sahel, they are not getting enough fresh grass, so they want to move towards the southern part of the country, and of course, in that, trying to disturb some of the natives who are there, and of course, resulting to clashes, and that's why we continue to have the farmers and others clash, which can be a huge security concern. So you can see how climate change has caused a lot of problems. So by the time we begin to embrace green finance, we'll see some reduction of some of these security issues. So what are the importance of green finance? Why the focus by investment experts to begin to look at green finance? Green finance plays a major role, a crucial role in addressing climate change and environmental degradation. They play a major role. One, mobilizing capital. Green finance helps mobilize capital for environmentally friendly projects and initiatives supporting the transition to a low carbon economy. You are more likely to raise funds if you say the funds are going to be used for projects that really support the environment. So we are seeing more and more. If I even see some activist group, investors, activist group, they always want to hold the board and management of their companies to make sure that they are following the principles of green finance. Reducing your carbon footprint by investing in renewable energy efficiency and sustainable infrastructure. Green finance helps reduce greenhouse gas emission and mitigate climate change. Promoting sustainable development. Green finance supports sustainable development by financing projects that promote environmental sustainability, social responsibility, and of course, economic growth. A company operates in a particular environment and they discharge certain effluent, harmful substance to the neighboring water body, and that water body is where the community does all their things. Then of course, the marine life, aquatic life in that water body, which these villagers make use of, will be affected, polluted. And when the villagers now go and make use of those aquatic marine life from that water body, they are also affected. So companies are gradually showing responsibility in terms of the environment. Managing environmental risks. Green finance helps manage environmental risks by incorporating environmental consideration into financial decision making and promoting sustainable practice. We don't have any other planet to go. It is the only planet that we have. So while we are here, we need to take care of it. Okay, so supporting climate change, adaptation, and resilience. So all these are the importance of green finance. Green finance also has benefits: job creation and economic growth, improve air and water quality, enhance energy security, and of course, increase transparency and accountability. These are some of the benefits. And of course, we have also mentioned some of the challenges of green finance. Now, environmental and social risks in finance, that is the ESG. Environmental and social risks in finance refer to the potential negative impact of financial investment on the environment and society. These risks can have significant consequences for financial institutions, investors, and the broader economy. So what are the environmental risks in finance? Climate change, investment in fossil fuel. Yes, I will also not support there must be a gradual, a transition. And that's why we keep talking about energy transition. Yes, for so many years, we are used to fossil fuel. Even the fossil fuel, I'm challenging some of the engineers there. Okay, we can come up with a more sustainable processing of these oil and gas assets so that it does not harm the environment just like that. Of course, the products, when they are out, they can be treated. So, but over a period of time, gradually, we can now phase out fossil fuel. But I don't agree if you say, let us just stop it tomorrow, because it is still a valuable asset. So for me, it is looking at improved technology, innovation on how to do the refining processes. So climate change, these are some of the environmental risks in finance. Climate change, investment in fossil fuels, deforestation, and other activities contribute to climate change, which can lead to physical risks, e.g. extreme weather events, transition risks, a shift to low carbon economy. Pollution, investment in industries that pollute the air, water, and soil can harm human health and environment, leading to regulatory risks, reputational damage, and of course, potential liabilities. We have seen that in the oil and gas industry a lot, especially in the Niger Delta. Biodiversity loss. When these pollutants, they are released to the environment, either to water bodies, of course, that's water pollution, to the air pollution, excuse me, to the soil, we talk of land pollution. They can also destroy some of the aquatic life. And even not just affecting those aquatic life, it can also have adverse effects on humans. So investment in activities that harm ecosystem and biodiversity can lead to loss of ecosystem sequence services, regulatory risks, and reputational damage. So industry should become more and more responsible. That is the financial risks involved, environmental risks in finance. We can also talk about the social risks in finance. Human rights. Investment in companies that violate human rights can lead to reputational damage, regulatory risks, and potential liabilities. Why will a company, or why will you patronize, buy the shares of a company, buy the bond of a company when they are using human labor? I mean, child labor. Your supply chain, you want to procure certain items that you need for your own production. Your suppliers are using children in their operations. They violate human rights. The conditions of the factory where their workers are the factory workers are not protected in terms of their PPE and other protective instruments that they need, for their optimal performance. Labor practice. Investment in companies with poor labor practices can lead to reputational damage, regulatory risks, and of course, potential liabilities. Then community relation. Investment in projects that harm local communities can lead to reputational damage. Yes, the community will no longer welcome that company, and it becomes a very difficult situation where you see the host communities trying to destroy some of the assets of that company. So if the companies have shown a lot of responsibility in terms of carrying all the stakeholders along, the communities, and the community is seeing the effort they are putting in trying to mitigate some of the risks involved in terms of the environment from their operation, of course, the community will be encouraged and they can work as partners. So how do we manage environmental and social risks in finance? Because this is also part of green finance. Environmental, social, governance, that's ESG integration, incorporates ESG factors into investment decisions to manage risks and identify opportunities. Risk assessment and management, conduct thorough risk assessment and develop strategies to manage environmental and social risks, and of course, stakeholders engagement. I will always continue to emphasize that. You know, we need to engage all the stakeholders. Engage with stakeholders, including local communities, NGOs, and investors to understand their concern and expectation. Transparency and disclosure, collaboration and industry initiative. Now, transparency and disclosure. If you are an oil and gas company, you operate in an environment or a community, you need to be open to your hosts so that your host will see you as a responsible corporate citizen. So, provide transparent and timely disclosure of environmental and social risks, as well as strategies to mitigate these risks. When, in fact, you go to Niger Delta, that's a major problem. There is a leakage somewhere of maybe of one of those pipes, and you are seeing the crude oil just leaking out from a pipe that has not been maintained and destroying that environment. Now, once this is identified, it is now left for the company to move on, respond as quickly as possible, get the engineers to see how it can be done, and of course, alert the host communities, then of course, the regulators and the government. If you don't do that, then the community believes that you don't even care for the environment. And at the end, they might even sabotage some of your activities. So in trying to solve some of this problem, then the host communities, the company, security operatives, and the government have to really collaborate together. We are not talking about an environmental issue here. We're looking at green finance. And we are saying investors should understand, if you want to invest ₦1 of your money, ensure that these companies have met this ESG standard. They are environmentally friendly in terms of their production, and also social, how they deal with their workers, how they deal with their community. So all this will go a long way in ensuring that finance has contributed its own quota to ensure that we all have a better environment. When we meet next time, we'll delve deeper into some of the processes involved in green finance. For now, green finance simply means when you want to take financial investment decision, you put the environment into consideration. Thank you.